Hello traders, in this video we're going to show you something a little bit different. This is the second video for today, Monday, and I want to show you how versatile a trading system should be where it can go long or short depending on the type of signals that exist. Now there are a few things we should focus on. The risk to reward ratio, how long to stay in the trade. I'm going to cover that here in this follow-up video. Remember that trading is risky. Please don't trade with funds you can't afford to lose. There always are risks involved with trading. So right now the market is going sideways. It's flip-flopping back and forth. No real opportunities. But then we have a signal here on the sonic system. It's exact. It's telling me to go short. So this is a sell. We're going to sell the market. First thing I'm going to look at is the risk
Order
and
filled.
the reward. It's about 50-50. You really should look at anywhere between 50-50, maybe 60-40. But in this case, it's pretty equal. The amount of money that I'm going to make compared to the amount of money that I could be losing is about the same. So we really are going to try to keep that within a proportion or ratio. Whenever there's a signal that it's upside down, heavily upside down, that's when I think we should let that signal go and wait for the next one. We have a lot of signals, so it's really unnecessary to trade every signal that comes our way. Pick and choose the ones that have less risk. So in this case, it's 50-50. It could be a little bit better if I got and I waited for a better price, right? I could have gotten maybe at a point or two better. But in this case, it's about 50-50. So that's the first thing that I'm going to focus on. The second thing you're going to notice is that the ATR, the average true range, right there, that yellow line down there, it's about 2.7. So what that tells me is that the trade and the environment, the volatility is healthy. It's on every minute you're looking at roughly 12 to 15 ticks of movement. So to me, that's a very healthy environment. Now, as far as the time, how long we should wait for this trade to either get stopped out or take a profit, and that's really important. That's called a time-based stop, is what I like to call it, what we like to call it. A time-based stop basically means that how long should I wait for the market to go in my favor before closing out the position. Some traders like to hold on for signals or trades for, let's say, an hour. I think when you're using a minute chart, that's way too long. You should only hold on to a position, especially a 1 minute chart, not more than 15 to 20 minutes maximum. If you're holding on to a position longer than that and it's probably at break even or a little loss or a little win, get out of the trade. There's nothing wrong with exiting the position. So in this case, think about every candle representing 60 seconds or 1 minute. So far, I've only been in this trade for about 3 minutes. If you think about that, that's not really a lot of time. 3 minutes, 4 minutes, that's almost insane to think that we can make this kind of money within 3 or 4 minutes. And with day trading, or if you're scalp trading, well, this is more day trading, we're waiting for this larger profit target, about 12 ticks, maybe
Target
13
filled.
ticks. The target is filled within 4 minutes. So if you think about that, that's a perfect setup, a perfect example. I took a trade earlier about 9:40 in the morning, so 10 minutes after the market opens. This is about 20 minutes later. So this is now 2 trades. I think that's actually good for the moment. I'm going to hold off on taking any more trades until I see a little bit more of a trend. So I'm going to wait until I see another short signal, or we'll just take a look at the very next signal, whatever it happens to be. Now remember, you can filter out many of these trades. So for those of you who are in Accelerated Mentorship, you have all the software. So you can add the Atlas line, you can add the Trade Scalper, you can add the blueprint, and especially the roadmap. The roadmap is very powerful. You can filter out signals where if there is anything conflicting, you can say, well, here's a signal that's telling me to go short. Here's another signal that's telling me to go long. Really, that is confusing, and you should hold off and not take any trade until everything is going in the same direction. In this video, we're just using the Sonic system, but I know many of you have other software, or you have your own software, your own methods of trading where you can use those as well to filter out trades. But for this example, in this video, we're only using the Sonic system just to show you how it works without using any type of filtering. Market's starting to go up, and it's also above that yellow dashed line. which is a filter. That yellow line you see there is included with the sonic system. It's part of it. Any signal that's above that will be long. So I know if there's a signal, it's going to be long if the market stays above that. Any signal generated below that hashed line, that dashed line there, will be short. So I actually know in advance whether or not the signal that is about to be generated will be long or will be short. And that really helps me because that way I'm not going to scramble to the chart trader or to the dome to enter long or to enter short. I know the direction ahead of time. So in this case, you can see that this is a long trade. Remember the rules. First rule is the risk to reward ratio. How does this trade fare as far as what we're about to lose in comparison to what we could win or make on the trade? And it's about 50-50, so that's what I like to see. The other thing I also notice is the volatility. It's healthy. It's about 10 ticks every minute. The market is moving at about 10 ticks, which is 2.5 points on the E-mini S&P. We do the same thing if it's the Nasdaq or the mini Nasdaq, the MNQ, if it's the crude oil, or if it's the MES, the micro E-mini. It works exactly the same way. The sonic system is based on price action, so it doesn't really matter the markets that you trade. I think what's most important is that you understand the rules, you look at the risk to reward ratio. In this case, the target was hit almost immediately. That's fantastic. If you're able to get it, great. Another rule that we have is we don't chase the market and we don't re-enter trades. So if the target is hit and you missed out on it, you were on a phone call, you didn't see it, that's fine. Wait for the next trade. We have plenty of signals. There's no reason to rush into this. There's no reason to retake trades or re-enter after the target is hit. Remember that there are rules involved with any type of trading. We teach you these rules. We show you exactly the ins and outs of price action trading. Now, if you're interested in the Sonic or you want to join Accelerated Mentorship, visit daytradetowin.com. Get a free member account if you don't already have one, and I'll see everyone in class. Want to learn more? Visit daytradetowin.com and get started with a free member account, which includes access to our trials, including the ABC software. Start learning the right way by using price action and avoid using conventional indicators. We offer unique strategies and proprietary software, including the Sonic system. Join Accelerated Mentorship and get instant access to all our software. Let's get you set up in the next training.